A very good afternoon to you, grade 12 learners. My name is Mr. Simbi, and welcome to today's accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Saibono Discovery Center. It has been a long time since we last met in this class. I know it is because you guys have been writing prelims and you have been studying. And I want to believe that you guys have already started the countdown, because in the next few days we'll be sitting for our paper one, that is the final exam. So having said that, I will show you today's objectives. Here are my objectives of the lesson. I will speak to the structure of paper one. We have done this in this lesson before. And then I'll look at the correct net profit after tax calculation. I'll also prepare the statement of financial position, and I'll also do the cash flow statement. All right. When we look at the structure of paper one, it is very key and very crucial to know that there is about 4 different types of structures that I'll speak to. 4 different structures that I'll speak to. And then the first one is where you have your calculation of correct net profit after tax and the statement of financial position. All right. So you will see that your first option, that is the first question, may change. And there's about 4 options or so that can be exploited there. But you see that this one here and that one there and that one there relatively remain the same. But anything can change nonetheless. So we would expect that if it is to change, it would be somewhere along these lines that we are discussing. So there's the calculation of correct net profit after tax and the statement of financial position. All right. So as I said, question 1 is structured in 4 different ways. Here is the next way. You will see that this cash flow analysis and auditing has remained constant then. But what has changed is what we have up here. In the first one, we have the correct net profit calculation together with the statement of financial position. But here now we have the statement of comprehensive income and the statement of financial position. So this has been seen in many recent past papers where you can have statement of comprehensive income. It can be a full one, or it can be having shaded places. And you can also have a full statement of financial position, or it can be the assets part or the equity and liability section. It can also have areas which are shaded as well. So this becomes your option number 2. Okay. It is advisable to handle transactions that are affecting both statements simultaneously. You will see when I do an activity that I'm going to do with you that we're going to have transactions that affect the statement of a financial position as well as the correct net profit calculation. And as we are preparing for paper 1, you see again that these 3 remain the same, and the statement of comprehensive income now is standing alone together with notes. All right. So that becomes option number 3. And the final option is where you have the statement of financial position here with notes, but these have remained constant as we had said earlier on. This is how you can approach your paper 1. In order for you to earn high marks for paper 1, in the first 10 minutes, that is the reading time, go through the question paper together with the answer book. You need to read them together at the same time. When you read the question paper, understand what the examiner intends for you to do, which will be determined by the structure that you find in your answer book. All right. And then when the invigilator tells you now to start writing, you need to go to your formula sheet, and then you label your formula sheet that you'll find at the back of your question paper. What you're doing is you are indicating, because when you get into the business of an exam, you might forget certain names of financial indicators which you knew. So it is advisable that when your mind is still fresh, go to the back there, indicate what is the name of this financial indicator: current ratio, asset test ratio, return on shareholders' equity, return on total capital employed, is it debt equity? Then you just put these names so that when you engage with these financial indicators later in the paper, you can still remember them. And again, it is not mandatory that you must start with question 1, come to question 2, 3, and then 4. I would advise you that you start with questions that you see are manageable, questions that you can get more marks out of. So do not start with question 1 if you feel question 1 is challenging for you, but rather start with questions that you can feel you can manage better on them. And try to adhere to time allocated per question so that you don't spend much time on a question that you understand, which ends up creating shortage of time for the other questions. If a question is difficult, I advise that you move to the next question, but only after you've exhausted your thoughts, but within time frame as well, that you don't end up wasting more time on that one particular question. All right. And then cash flow and corporate governance questions. These are questions that if you are fully prepared, you stand to gain a lot of marks. If you understand your cash flow properly and you have prepared adequately on your corporate governance, as well as your auditing, you should be able to get more marks on these questions. All right. And as we said, remember to use your formula sheet. The next thing that I want to talk about is know which amounts to add and know which amounts to subtract. Very key. Signs are very key. You must know what to add and you must know what to subtract. And know where to place your brackets. Know where to place your brackets. That means expenses and outflows of cash. And you see when we do the correct net profit calculation as well. And then always add amounts that are pre-printed in your answer book. You'll find that in your answer book, there's amounts that are already in there. Always add those amounts that would have already been pre-printed for you. And when you analyze the information, code figures, indicators, as well as trends. And then read questions from your question paper and answer book. And always show your calculations to earn part marks. Calculations are very key, that you show your calculations on the answer book. On the answer book, we show our calculations in order to earn part marks. Workings must be shown on the answer book and not the question paper. Remember, you don't submit the question paper. Don't do all your calculations on the calculator. Write them down on the answer book or together. And then prepare adequately for this paper. All right. And then paper 1 also assesses, this is very key now, that when you're preparing for paper 1, remember it also assesses tangible assets. It also assesses inventory. But internal control on tangible assets is tested in paper 2. All right. And then inventory, the closing stock of any 3 methods, that is your FIFO, weighted average, and specific identification can be tested. And then you can be able to calculate your trading stock deficit or surplus. You will see as I engage with today's paper that tangible assets can be tested in both paper 1 and paper 2, as well as inventory can be tested in both paper 1 and paper 2. There are certain aspects that can be tested in paper 1 and certain aspects only remain in paper 2. But it is key that you know all your 3 methods to inventory valuation. Okay, so without further ado, we're going to begin with activity number 1. As it is our culture, you need to have your calculator, you need to have your pen, pencil, whatever it is that you need to use so that we can be able to do calculations together. My dear learners, we're going to take a short 2-minute break, and I see you in 2 minutes' time. And welcome back. Before the short break, I was trying to give you tricks and tips on how to approach your paper one. Okay, it is very important that you put in the time. Nothing substitutes preparation. It is very important that you prepare. You need to give yourself time. You need to sit on that chair. You need to sit on that desk. You need to put in the hours. Prepare adequately. I have no doubt that if you prepare adequately, go through several past papers, not just going through, but with understanding, if you prepare adequately, I do believe you can make it at the end of the year. So we're going to do together activity number one. So I picked an activity which is going to test two things: the statement of financial position together with the correct net profit calculation. So a statement of financial position together with correct net profit calculation. Let's see what we have. Okay, so it reads, Lizzie Limited. The information relates to the financial year ended on 28 February 2025. The business sells luxurious electrical items. So what we're going to do, we're going to calculate the profit or loss on sale of a vehicle. Remember, this can be tested in paper one. And we're going to calculate the value of closing stock of electrical plugs using the weighted average method. So here we're testing fixed assets. Here we're testing inventory valuation. So these have all been tested already. You can see that they're coming into paper one. And then the next question then says, refer to information A and B. Use the table provided to calculate the correct net profit after tax. So we then come into the calculation of the correct net profit after tax for the year ended 28 February 2025. And indicate with a plus or a minus for a decrease. A plus is for an increase and a minus is for a decrease for each adjusted amount. And then lastly, complete the statement of financial position on 28 February 2025. Note, some amounts have been entered in the answer book. Figures are not required in the shaded areas and show workings. Okay, so what we're going to do is, we're not going to answer these questions the way they are. We are going to look at the information. So I want to look at an adjustment and see how we can break it up. You're still with me? We're going to look at an adjustment and then we see how we can break up that particular adjustment. You ready? Okay, let's do this together. So the first adjustment that we have, we are given obviously the net profit before tax, which is 3,825,850. And they say it was calculated before taking the following into account. So we need to take into account a couple of adjustments and we see how it's going to affect the calculations. So at the same time, we're going to calculate the profit or loss on the sale of vehicle. Let's see if we can do that. And then, so that I do not end up writing in the wrong space, we are going to show our answer on the correct net profit calculation, and we'll also show what goes into the statement of financial position. Let's begin. We are told on 1 December 2024, very key to note your financial period. This financial year ends on the 28th of February 2025. That means it began on the 1st of March 2024. This was the beginning and this is the end. So you have the beginning and you have the end. We good? All right. And then on the 1st of December, so this is during the financial year, an old vehicle was traded in. Traded in. You have to understand trade in. Trade in means we're taking the old one, disposing it, and we are bringing in a new one. So there's two vehicles involved. When we deal with the trade in, we are disposing the one and we are getting a new one. That's a trade in. So we are told on 1 December, an old vehicle was traded in for a new vehicle, valued at 180,000. Okay, so we have two vehicles there. An old vehicle was traded in, and for a new vehicle valued at 180,000. All right, and then the trade-in value was 125,500. The amount received was recorded, but no further entries were made regarding the sale and depreciation. No entries were made regarding the sale and the depreciation. Details of the vehicle sold. We have the carrying value of 148,000 and depreciation is at 15%. Okay, let's get the calculators ready. So we understand that we have two vehicles. We have an old vehicle, which is the one that is being sold. We have the sold, and we have a new. Okay, so, let me replace the old with the sold there. Let me just say sold there. So we have the sold vehicle and we have a new vehicle. With the sold, we are given the carrying value to be 148,000 there. 148,000. That is the carrying value. And we have a new vehicle, valued at 180,000. Two vehicles. One is being sold, traded in, and a new one is coming in. Now, we are to calculate the profit or loss on the sale of the vehicle that we are disposing here. We would know, therefore, that if we're given the carrying value, we are not going to get the cost of this vehicle. We're not going to get that cost. And it is not necessary to get the cost. Once you have the carrying value, it will assist us, therefore, to get the profit or loss. Now, I know that if I have my carrying value at the beginning, which is this one, and I subtract my depreciation for the year, it should give me my carrying value at the end. If I have my carrying value at the beginning, I subtract the depreciation for the year, it should give me my carrying value at the end of the year. You still with me? So I'll come in, then I'll say my carrying value at the beginning is 148,000. Like that there. I need to subtract my depreciation for the year. How do I calculate depreciation? Depreciation is on the diminishing balance method. So I'll come in, then I'll say 148,000, and then I say multiply that by the depreciation rate of 15%. All right, and we had this one from the beginning, which is from March, and the trade-in is happening on the 1st of December. You need to know that if it's the 1st of December, you're counting only up to the 30th of November. So we're going to take out our fingers here and we're going to count. It's going to be March, April, May, June, July, August, September, October, November. How many months is that? That gives you 9 months. So we had this vehicle for 9 months, 9 over 12. Let's see if our adding machine is still working. There you are, my good friend. All right, let's see. So it's going to be 148,000. Then we multiply that by 15%. We multiply that by 9 over 12. All right, let's see. That's going to give me 16,650. So I'll come here. My depreciation on this sold, is 16,650. At the same time, I have to remember that once I get depreciation, it must be recorded in the correct net profit calculation. So I'll come in, then I'll say depreciation. And I have my 16,650. That becomes the first amount. So if I say 148 minus 16,650, let's see how much it's going to give us. Let's come here. 148,000 minus 16,650. And that is going to give us 131,350. 131,350. That is the carrying value on the date of disposal. Okay. We are then told it was traded in and we received 125,500. And here we want to calculate either the profit or the loss. So we come up again with another method that says selling price minus carrying value is equal to either profit or loss. If it's a positive, it's profit. If it's a negative, it's a loss. So selling price, the trade-in value of 125.5 minus the carrying value of 131,350. Let's see what the calculator is going to say. Let's remove everything. 125.5 minus 131,350. That will give us 5,850, a negative. So I have a negative 5,850. Okay, so if I come here, my answer is 5,850. And I know that if it's a negative, therefore it is a loss on sale. It is a loss. Because here they wanted us to calculate either the profit or the loss. And we know this is a loss on sale. Why is it loss? Because we received 125,500 for a vehicle with a carrying value of 131,350. So our vehicle has a higher carrying value than the value that we received when we disposed it. Now, once we are there, you have to understand that here we're given fixed assets and this is at carrying value. So I'll therefore come to my fixed assets and I'll say the first thing, I'll take off the depreciation for this sold, 16,650. And then I'll also come and subtract the carrying value on the date of disposal, which is 131,350. So I subtract these two amounts. In other words, I subtracted the 148, the carrying value of the asset that we've disposed. I take it out, the 148, but you can show it separately as I've done here. Okay, and then once we're done here, therefore I am left with calculating depreciation for the new. And my new is 180,000, as you see here, and the depreciation rate is 15%, and it becomes easy now because you're counting from the 1st of December, January, February, that's 3 months. If you use the other method, you would understand that trade-in means one is coming in, one is going out. So when the old one, the sold is going out after 9 months, then the new one is only going to be there for 3 months so that we end up with 12 months. So we come here, then we put it on the calculator, and we are now saying 180,000. We multiply that by 15%. We multiply that by 3 over 12. By 3 over 12. And that will give me 6,750. 6,750. So we come here, depreciation is 6,750. Like that. All right. So I would still come and do the same. And I'll say minus 6,750. I would still come and subtract that amount over there. This is how you would have done your calculations here. So what am I emphasizing here? I'm emphasizing point number one. When you calculate your depreciation, it would affect the correct net profit calculation. And then, so you would see here, I would close my bracket here on depreciation. And my depreciation would therefore be, here it's going to be 23,400. And depreciation, it's an expense that was not yet recorded. So that's my point number one. You record depreciation, you're subtracting it. An expense was not yet recorded. So it would decrease our profit in that case. Point number two, we calculated the loss on sale. And that loss on sale must be recorded here. Loss on sale of asset. And once we have a loss on sale of an asset, that's an expense. That's 5,850. So it will decrease our profit in that case. So you have calculated it here as it was required, but you also show it over here. But what is more interesting is your disposal on carrying value must be shown in the statement of financial position. You have your fixed asset at carrying value here, then you come and you subtract the 16,650, that was the depreciation, and you subtract the carrying value of the asset on the day of disposal. And I said earlier on, you could have simply subtracted the 148,000 because the asset has been disposed. And then you also calculate the depreciation for the new, and you subtract it from your fixed assets. So you were required to do a couple of things that pertains to your fixed assets over here. Okay, I hope you're good. Let's move on to the next adjustment. The next adjustment reads as follows. We have debtors, control provision for bad debts, and then we have information number 2 there. So you can see I started with information number 1, now I'm in information number 2. I'm going to keep going down with the information until I get to the very end. Information number 2 reads, creditors with debit balances of 10,550 on 28 February must be transferred to the debtors ledger. Provision for bad debts must be adjusted to 4% of debtors. Okay, so let's do this. We know we're gonna record it in our statement of financial position, and we will need to show what goes on in the correct net profit calculation. Let's see. But we are told here that we have creditors. So that means I'm coming here. This is my creditors ledger, liability. So on the credit side, it's a plus. On the debit side, it's a minus. Creditors with a debit balance of 10,550. So it's going to be 10,550. Okay, so it's creditors with a debit balance. Remember, creditors must have a credit balance, liabilities. But if your creditors have a debit balance, it means we overpaid them. So in this case, they now owe us. So we must transfer them now to the debtors books. That is where we keep information of the people who owe us. So we are going to come and we now say debtors ledger here. On the debit side, that's a plus. On the credit side, that's a minus. So we have 10,550 and we need to take it out. So to take it out, we're going to bring it to the credit side. That's 10,550. And to complete double entry, we're going to come now to the debit side. That's 10,550. So what is key are the signs here. What is key are the signs here. So I'm going to come now first to my trade and other receivables, which is my debtors. And I'm going to say, what sign do I see there? That's a plus. So I'm coming to say, on my trade and other receivables, plus 10,550. And the next one, I'm going to go to trade and other payables. Then I'm going to say plus 10,550. So I've recorded these two amounts. The biggest temptation is your mind is going to tell you, edit somewhere and subtract it somewhere. No. And you need to practice because these transactions come very different. This one is creditors with a debit balance. You can also find where you have debtors with a credit balance. And you need to be able to draw the T accounts and see how you can transfer it. But you will never find a situation where in the debtors it's a plus and in the creditors it's a minus. In most cases, you'd find it's because it has to be double entry. That means you debit one account, you credit the other account. And these are opposite accounts. So the moment you debit one account, you'll be adding. Then the moment you credit the other account, you still be adding. So it will be a plus plus or it will be a minus minus. You need to expose yourself to several of these transactions that you can see how the examiner normally tests such transactions. Then it goes on to say, provision for bad debts must be adjusted to 4% of debtors. So you can only do this transaction after you are completed with this one. You do this one first, then you can come to the provision for bad debts. And for you to calculate the provision for bad debts, you need to say 688,200 plus 10,550. Let's see on our calculator. So we're saying 688,200 plus 10,550. So we added those two amounts. And they'll give us 698,750. 698,750. So I'm coming here to say 698,750. And then we calculate the provision for bad debts, which is 4%. Then I get 4% of that now. All right. Then I'm coming here and I'm saying times 4%. And that's going to give me 27,950. So I get 27,950. 27,950. Now, what we're going to do now is to now say, in the correct net profit calculation, we need to know whether it's income or an expense. So we need to compare last year's provision and this year's provision. And last year's provision for bad debts was 30,450. And this year's provision is 27,950. Already you can see that our provision for bad debts has decreased. And a decrease is income. A decrease is income. By how much has it decreased by? 30,450 minus 27,950. That's going to give me 2,500. So it has decreased by 2.5. So now, once I have calculated the 27,950, I must take that 27,950 and I bring it straight onto my trade and other receivables. Trade and other receivables. Trade and other receivables. Minus 27,950. You subtract it there in trade and other receivables. The amount, the 27,950, I subtract it as it is. 27,950, I subtract it from my trade and other receivables. What goes to my statement of comprehensive income or correct net profit calculation, what goes to one of these two, is either an increase or a decrease. Can I repeat that again? Okay, so what we did here, we calculated the 4% and it gave us 27,950. The 27,950, automatically that amount as is, we come and then we subtract it from our trade and other receivables, minus 27,950, as we see here. Then you calculate either the increase or the decrease, which you see is 2.5. If the examiner is testing you on the statement of comprehensive income, you record that as other operating income, provision for bad debts adjustment. But if you are doing the correct net profit calculation, you still come and then you have your provision for bad debts adjustment. And to show calculation, remember we show calculation, 30,450 minus 27,950. And then you end up with 2,500, like that. That is how you would do this adjustment. Okay, so that adjustment the creditors with the debt balance affected your receivables and the payables. And your provision for bad debts affects only your receivables as well as the statement of comprehensive income or correct net profit calculation. I'm going to move on to the next adjustment. And here we were required to calculate the value of closing stock using the weighted average method. All right, but we know we're calculating correct net profit calculation, and there is a statement of financial position as well. Okay, let's see what we can do out of here. Now, first things first, we do the information in its rightful order. It says, the company donated goods to a local orphanage. A gross profit of 12,000 was going to be made on these goods sold. So, we donated goods. We know that all goods have a cost, which is 100% when we're selling them. And then they have a markup. In this case, the markup was 80%. Markup is profit. Markup is profit. Markup is the gross profit, which in this case was going to be 12,000, the gross profit. The selling price would therefore be 180%. Now, we need to record donations, but from grade 10, you have been taught that donations must be recorded at cost. So this is a grade 10 adjustment, I must say, because we need the cost, which is 100. And what we have is not the selling price, because you're used to getting the selling price. But in this case, we're given the profit, the markup, we're given the 80. So we want 100 over 80 multiplied by the 12,000 like that. And then let's see if we bring our good friend here. Okay, let's say we want 100 and we have 80, and then we multiply that by 12,000. That is going to give us 15,000. So the cost of these goods is 15,000. That is the cost of these goods, 15,000. The cost of these goods is 15,000. Let's donate them then. If you're donating the goods, that means we're going to come to our inventory and we're saying stock has gone out, 15,000. Oh, Simbi, write a nice 5. I don't know if you can see that 5. Okay. All right. Write a beautiful 5, Mr. Simbi. There it is. Minus 15,000. And then we come here because it is an expense then. Though we come here, then we say donation. And then we're going to come, and then we're going to say 15,000. What are we having? An expense. So we have an expense that was not recorded, so that expense is going to decrease our profit. So we're going to have it in bracket. Let's come to the next part now. We are told the following stock sheet relates to electric plugs. It was omitted when the final stock figures were calculated. I think you've seen several of these ones where they say the stock was omitted, or they say the stock was destroyed, or the stock was miscalculated. Several times we've seen these kind of adjustments that have to bring in an inventory valuation method, and that particular stock was omitted, stolen, destroyed, and all these other funny adjustments. You need to expose yourself to such adjustments. Maybe the stock was donated. So you need to be able to calculate the value of stock and then adjust it according to what the examiner would have said. All right. So here we are required to calculate the value of closing stock, but the key is it was omitted when the final stock figures were calculated. So we're coming here and then we're going to say, then we have rands and we have units. So remember the periodic inventory system way of calculating cost of sales. At the top we have rands, at the bottom we have units. But you're going to say opening stock plus purchases plus carriage plus customs duty minus returns. Or you can say opening stock plus purchases minus returns plus customs duty plus carriage. Rands at the top, units at the bottom. We together? Let's go. How much is our opening stock? 174,400. So I come here, it's 174,400. And then how many units is that equivalent to? That is your 800 at the bottom here. 800. Then I say plus. Then we are given purchases separately. You can see here I have May and I have September. May and I have September. So I'm going to record them separately as they were given. 501,400, which is 2,300 plus 2.3 here at the bottom. Then plus again 440,000. 440,000, which is 2,000 plus 2,000 here. Okay. And then sent back to the supplier. These are returns minus 100. And then these were sent back to the supplier from May purchases. So I'm going to say here 100. In May, the unit or the cost per unit is 218 times 218. Okay, so if I do that there, how much is that going to give me? If I do that there, that's going to give me 21,800. Remember that was sent back, so that's 21,800. So I'm going to take my calculator. I'm going to say that plus that minus that. And that's going to give me 1,094,000. And then I say 800 plus 2.3 plus 2,000 minus 100. And that is going to give me 5,000. And then I divide this 2. And then I end up with, let's see if we can do it together now. So I'm going to say 1,094,000. I divide that by 5,000. That's going to give me 218.8. 218.8. Then I multiply that by the units at the end, closing stock, which is my 1,250. So I multiply that times 1,250. And that's going to give me 273,500. 273,500. That becomes my stock that was omitted. Now, I'm going to come here and I will now say on my inventory plus 273,500. Okay. Now, in the event that the company had identified a trading stock deficit, if the company had a trading stock deficit, that means it had an expense. You would therefore go and you would reverse that with the 273,500. So you will be adding it in the event that you are having a trading stock deficit. Are we together? And if you were having a trading stock surplus, therefore it means your surplus would have increased in that case. But the examiner can play around a number of ways with this particular adjustment. All right, it is very, very key to note that once you've calculated your stock, you should add it to your inventories because it was omitted, and it will have an effect on a trading stock deficit and trading stock surplus. All right, so here we recorded our donation and we've calculated the stock using the weighted average method. Let's go on to the next adjustment, and as usual, we're recording in the two statements. It reads, advertising includes a 6 months premium of 18.6 paid on the 1st of November. Timelines are key. This financial year ends on the 28th of February. So if it's ending on the 28th of February 2025, it began on the 1st of March 2024. All right. And then we have a 6 months advertising premium, which is 18.6 paid on the 1st of November. So if we paid it on the 1st of November, 6 months after November, it will be November, December, January, February, March, April. So the 6 months end in April. That is 30th of April 2025. Our problem therefore becomes here. This therefore becomes our problem, which is March and April. So you have 2 months that have stepped out of the entire 6. Multiply that by 18,600. Then we come here and we now say 2 months have stepped out of the 6. And then you multiply that by 18,600. And that's going to give me 6,200. So 6,200 therefore becomes my prepaid expense. If I have paid an expense in advance, it means I overstated my expenses in the correct net profit calculation. If my expenses were overstated, my profit was understated. So to correct that, I would therefore come and then I would say advertising here. And I'll bring my 6,200. The question is, are we adding it or subtracting it? It's an expense that was overstated. We recorded more of the expense. So to correct it, we must add plus 6.2. But then what do we do in the statement of financial position? Remember, this is a prepaid expense. So we expect to receive it. It is receivable. So we come here, then we say plus 6,200. It is a prepaid expense. Let's go on to the next adjustment. And the next adjustment then reads, a debtor who had previously been written off transferred 450 by an EFT. So if a debtor was previously written off, is then paid 450, that one we call it bad debts recovered. And that will increase our profit plus 4.5. You are aware of the errors that go on around this particular adjustment, where that amount may be recorded under the CRJ debtors control column, and then you have to do the correction. It's very important that you expose yourself to those kind of errors, that you can correct them properly when you are doing the statement of financial position as well. Okay. And then if you have bad debts recovered, remember, it goes into a statement of comprehensive income under other operating income. And if you're doing correct net profit calculation, it comes here in to the correct net profit calculation, and you're adding it. Bad debts recovered. Let's go on to rent income then. Rent income. Same thing. We're going to record it into 2 places. It was agreed to increase rent by 5% on the 1st of December 2024. There is many rent adjustments. You need to expose yourself to these different kinds of rent adjustments. Even if it's a rent adjustment that pertains to cost accounting, factory overheads, the same criteria can be used to calculate rent when you are in the statement of comprehensive income or the correct net profit calculation. Any of these can be exploited by any examiner. It was agreed to increase the rent by 5% on the 1st of December. According to the agreement, a deposit of 8,000 is paid before the tenant occupies the building. The deposit was received but not recorded. Rent for March 2025 was received and recorded. The lease agreement starts from the 1st of May 2024. Okay, let's go. Timeline, very key. So we're ending 28 February 2025. We're ending here. Therefore, we're beginning 1st of March 2024. We begin, we end. Cool. And then the lease agreement starts on the 1st of May 2024. All right. So we are then told that on this day, rent for March, all right, March. So we have this 1 month here. Okay. So if the lease agreement was signed during this financial year, the deposit of 8,000 would have been received then. And once we receive a deposit of 8,000, it is money that we're receiving, and it is payable then, because we ought to pay it back to our tenant the moment they'll be moving out. So it will increase our payables. So you come here and then you say our payables are going to increase by 8,000. You'd remember in grade 10 we had this, but we were doing it as we were renting an apartment, a building. In grade 10, that's where we normally do it. When we move into a building and we pay a deposit to our landlord, we would record it in our books as receivable, because we can receive that money within 12 months. The opposite of that therefore becomes true, that if we are the landlords now, our tenant, when they move in, they'll give us a deposit of 8,000, and that money is payable within 12 months. So you take it to trade in other payables, 8,000. That is the deposit on rent. Now, we know that we have received rent from the 1st of May. We're told here May, June, July, August, September, October, November, December, January, February. The year was supposed to end, but then we received for March. So we received rent for 11 months. But not all 11 months had the same rent, because rent increased by 5% on the 1st of December. So that means from May to December, 1st of December. And we've explained this earlier on. Once you see 1st of December, you are coming to 30 November. So you're going to say May, June, July, August, September, October, November. You have 7 months. You have 7 months where the rent had not yet changed. That means it's 700 here. And then from December, January, February, the year was supposed to end, but we received until March for 4 months. Rent was then increased by 5%. Therefore, it gives you 105 here. 4 times 105, that's going to give you 420. So 700 plus 420, that gives you 1,120 here. This is therefore equivalent to the rent that we have received, which is 216,000 over there. Now we can say what you want over what you have. We want rent per month after the increase, which is the March year. So we want 105 here. And what we have is the total, 1,120. And we multiply that by 216,000. So let's see if the adding machine, thank you, my friend, will say 105 over 1120. Then we multiply by 216,000. That is going to give me 20,250. 20,250. 20,250. What is that? That is the rent for the month of March. So we have rent income here of 20,250, which we have received, but in advance. So when we received this rent, it increased our profit. It overstated our profit. And once our profit is overstated, that is wrong. So to correct it, therefore, we come and we subtract it. So we say minus 20,250 there. We subtract this one, minus 20,250. And then, if we've received income in advance, it should go to trade in other payables. So we come to trade in other payables, then we say plus 20,250. Okay, my handwriting protruded there. It is not supposed to protrude like that. It should have been contained in its place. Okay, are we good? But the examiner can test this either way. It can be accrued income, or it can be an expense, rent expense. Therefore, you need to adjust it accordingly. You need to expose yourself to such adjustments on the rent. Remember, there's also the one where rent increases by 1,120, and you are not given the percentage, but you're given the amount. And then you need to do those particular adjustments. Okay. The next adjustment then says only 80% of consumable stores are used. All right? Only 80% of consumable stores were used during the year. All right. So when we come here, we know that these are consumable stores used. So this is the 80% here. So we must have consumable stores on hand. On hand. And the consumable stores on hand is the 20. But what we have is the 80 times the 60.8. So we therefore come here and we say, we want 20. We have 80. And we multiply that by 60,800. And we end up with 15,200. Like that. Consumable stores on hand. Now, when we're doing the correct net profit calculation, remember we are correcting errors. So the understanding therefore would be the entire consumable stores amount was recorded, the 100%. Remember, you have purchased consumable stores 100%. 100% is what was purchased. And then 80% was used. And then 20% is on hand. So normally when we prepare the statement of comprehensive income, if I were to put amounts here, it would mean the 100% would be 76,000. The 100% would be 76,000, 60.8 plus that one, 76,000. 76,000 rands here. And then the 80% used, that's the 60.8. Hence, the 20%, the on hand, becomes the 15.2. Okay. If we were preparing the statement of comprehensive income, we would come under operating expenses and would have consumable stores. And we would therefore say 76,000, which is what we paid for the consumable stores, minus the ones on hand, which is 15.2. Therefore, the used one, which is 60,800, is what we record here in the statement of comprehensive income. This is how we do this adjustment. The used always comes here. Now, if an error has happened, it would mean that they recorded the entire 76,000. So in order for us to correct that, our expenses were overstated. Therefore, profits were understated. It would mean that we would come here and then would say consumable stores. And we're coming to record the 15.2. And that 15.2, remember, the profits were understated because expenses were overstated. So would come and then would be adding that 15.2 so that we reinstate our profits. And the same 15.2, we then come and we add it to our inventories plus 15.2. But in most cases, the examiner would be very clear as to what would have transpired so that you can do the correct recording. All right? Okay, so I'm going to move on from this transaction. It reads, 130,000 was still owed to SARS for income tax on 28 February 2025. So when we come here, we're in the correct net profit calculation, and then we will do our statement of financial position as well. Okay, let's see. if we are told, because we are given the provisional tax payments, 870, remember this has already been paid. So we'll come here and we are having our income tax here. Our income tax. So we have our provisional payments, which is 870,000. Then we are told 130,000 is still owed to SARS. Apart from what we've paid, we are still to pay 130,000 because it is still owed to SARS. So it therefore means 870 plus 130, then we have 1 million here, which is our income tax, and we're subtracting it, 1 million. And the amount that is still owed to SARS, we therefore bring it here under trade, under current liabilities. As SARS, my handwriting there, income tax. SARS, income tax. And that's 130,000 over there. 130,000. Still owed to SARS, 130,000. Now the examiner can play around with this one. They can bring percentages, 28%. Several ways in which an examiner can test this thing. They can give you the net profit before tax and net profit after tax, and you have to figure out the difference several ways. Or they can give you the balances, the way it's calculated from the cash flow statement, and you're bringing it here. Several ways in which this can still be calculated. I would advise you, expose yourself to several SARS income tax adjustments because it will affect both the statement of comprehensive income, correct net profit calculation, and the statement of financial position. Either one, it will be affected. But once the amount is too owed to SARS, therefore it goes to trade and to current liabilities. The other way that the examiner would have changed this one was 130,000 is receivable. Receivable simply means the provisional payments are more. So if you would come here, if it is receivable, you would be saying 870,000 minus 130,000. That is if it is receivable. They're simply trying to say when you made provisional tax payments, you paid 870 and it is more by 130 according to the tax assessment. Then your income tax amount therefore would be 740,000. That is if that statement changes from owed to receivable. Then we would therefore bring it to trade and other receivables or current assets. We'll bring it to current assets. And then you say under current assets, SARS income tax. SARS income tax because it is receivable. We good? Okay, so very key, very key. You need to expose yourself to several SARS income tax adjustments. Let's go on to the next one. Okay, so after this one, you were supposed to calculate your net profit after tax. I've calculated mine because remember we're doing it broken down into many pieces. We're doing it broken down into many pieces. I'll give you mine that it calculated, which was going to be 3,062,750. 3,062,750. That was my income tax that I have. So when we come here, you're going to see why we needed that amount over there. Okay. So we are then given retained income 1 March 2024. This is at the beginning. Okay. So you will have to remember there are 3 different types of retained incomes that you get. Yes, 3 different types of retained incomes you can get. There's the retained income at the beginning of the year, which is this one here. Then there's the retained income at the end of the year. Then there's the retained income after the repurchase of shares. All right. So you have to know these 3 different types of retained income, especially if you're required to do a retained income note, because you would treat them differently. Retained income at the beginning goes to the beginning. Retained income at the end goes to the end. But retained income after the repurchase of shares, that's something that you really need to work on as well. Okay, let's go on to the next one. And then it says, so we're given retained income here, which is 384,000 here. And then we're told the company is registered with an authorized share capital of 2 million ordinary shares. On 31 August, the directors decided to buy back 20,000 shares. So if we're given the retained income at the beginning, that means we're supposed to open a retained income note number 8, or you can do it here and show calculations here. That means you see a balance at the beginning. The next thing that you're going to bring is net profit after tax. And I said I'm going to give you mine, which is 3,062,750. Okay. Then the next thing you're going to bring is the repurchase of shares. On 31 August, the directors decided to buy back 20,000 shares at 1 rand 80 above, more above. So 20,000 times 1 rand 80 here. All right. Let's see if we have an adding machine to help us. 20,000, that's 200,000 CP. 20,000 times 1 rand 80, 1.8. And that would give us 36,000. So you come here, then you say minus 36,000 over there. Minus 36,000 over there. Okay? And then they say, on 28th February, only 80% of the authorized shares were in issue. Okay? So they're speaking to that one there. And then they say a final dividend was declared. They don't tell us. All right? And then we are then told that total dividends for the year is 1,044,000. Total dividends for the year is 1,044,000. All right. So we would therefore understand here, when we come here, that if you want to complete this one, you can come and then you subtract again your total dividends. Remember, total dividends includes your interim as well as your final. That is your shareholders for dividends. So you're going to come in and subtract 1,044,000 here. 1,044,000 there you subtract. And then you can close your bracket and then you get your retained income. So here we simply did the note, but not in a note. We simply did the note over here. And you should get 2,310,275. And then you add these two amounts, they give you that figure there at the top. That is one of the ways in which you would have done this. I just wanted to explain this aspect here altogether. And then we'll also touch our shareholders for dividends. The other aspect that I wanted to touch before I move on to my next activity is the loan. The loan. When you come here, you will see that you have a loan adjustment and it reads, balance at the beginning was not given here. But remember, we're preparing the statement of financial position. So you're given the loan at the end, which is 720 over there. Now, we are told repayments during the year is 289.5. The loan repayment schedule expected to remain the same. So at times, other examiners would just come here and say fixed monthly repayments here, fixed monthly repayments. It's exactly the same thing as what you see here. Then they say the monthly repayments are expected to remain the same for the remaining term. However, a notification was received from the bank that interest on loan will increase by 6% per annum. So, we understand that when we made these repayments of 289.5, we're paying for two things. Number one, we're paying for interest, which was 79.5, and with the loan repayment, the capital portion of the loan, which would therefore become, let's go back, where we were. Aha, we're looking for this one, which would therefore become, if we say 289,500 minus 79.5, it would give us 210,000. So the loan repayments were 210,000. That we know. Now, we're told that we have received an SMS and it has notified us that interest will increase by 6%. That means our interest, which was 79.5 times 106 over 100. So we come in, then we say 106 over 100 times 79.5. That will give us new interest of 84,270. Interest in the next year will be 84,270. If interest will be 84,270, we're going to come again and we do the same. If interest will be 84,270, yet the monthly repayments remain fixed, which is 289,500. The difference between the two will give us the next year's capital portion of the loan to be paid. So we therefore say 289,500 minus 84,270, and that will give me 205,230. 205,230. So I'll therefore come here on the loan, then I'll say minus 205,230, and then I'll bring it here as my short-term loan, 205,230, like that. Okay, dear learners, we're going to take a quick 2-minute break, and then when we come, I'm just going to touch the cash flow statement briefly, and then we call it a day. See you after 2 minutes.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinganga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you are gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Welcome back, dear learners. And before the break, we did a couple of adjustments that pertained to the correct net profit calculation and the statement of financial position, but we were incorporating the statement of comprehensive income as well. So we can say we did three things: statement of comprehensive income, correct net profit calculation, and the statement of financial position. Now, we are about to begin a cash flow statement. But because of time, I'm not going to be able to complete the statement of this cash flow statement because of time. So I wanted to invite you to a lesson next week, Friday. Next week, Friday, this very same time. Then we're going to cover cash flow statement, analysis, and interpretation of financial statements. Next week, Friday, let's make a date. We'll meet again in the same place. And then we're going to do cash flow statement and analysis and interpretation of financial information. So I hope that you guys are going to be studying. Please keep these calculators moving. Make sure you do your best in preparation. Next week, Friday, same time. That will be our last class. Tell friends to tell their friends that we're going to be doing cash flow statement, and we're going to spend much more time on the analysis and interpretation of financial statements. Until next time, goodbye and take care.